been a very strong week for risk assets. And so the question I would like to pose this week in this Steady Wealth podcast episode is whether this is the beginning of the year in rally, or maybe already a good part of what we could expect. And maybe that's it in terms of upside. Hey everybody, Serge Berger here from the Steady Wealth podcast. Hope everyone's doing well. We came into last week, the end of October, warning our clients that the market, and I'm referencing here risk assets, particularly equities, looked like they were oversold. And that really ran the gamut from US equities to European equities and other asset classes. The reason we made that call for an oversold bounce, I'm going to call this a bear market rally, and we'll tie this into the sort of the broader spectrum of where this fits within the fourth quarter and seasonality and so on and so forth. But the reason we made that call was largely technical in nature, and also what we had on the radar this past week, what we were looking to expect in terms of economic data. Which brings up an important point, and I like to always mention this to people who want to be a bit more self-directed, or people who like to at least engage in smart conversations about markets and their money with their investment advisor, which is what I would absolutely urge everyone to do. I understand a lot of people are trying to do it themselves, or at least trying to do some of the money management themselves, which I think the latter part is good. I think trying to do it all themselves is potentially I would even say it's just foolish, because it's just way too big a thing to do. Unless, of course, that's been one's financial profession and that's their thing. I think managing their entire net worth is a very difficult thing, and probably for most people an impossible thing to do, and they will underperform the market. Like even just the basic market, forget trying to even generate any alpha, they will underperform. Anyway, that's my sort of note on that. As you guys know, I always like to sneak that in because I feel so passionate about that. And we see this, not just me coming up with a theory, this is in fact actually happening. However, let's talk about more specifically what actually happened last week and why we got that risk on move, meaning people took on risk. That's what risk on means in terms of equity. So to put this into perspective, so if we look at the last week's price action, what we saw was essentially anything that was interest rate sensitive was rallying, what was outperforming. So we look at, for example, things like real estate. That would be represented by the XLRE ETF, was up almost 9%, call it 8.5%. Financials up 7.5%. Home builders were up strongly as well. So anything really that was very strongly correlated to an interest rate move lower, and I'll touch on that in a minute. Interestingly, energy actually underperformed and still up 2.5% or so for the week, but technically underperformed. What's ironic about all this is why this all started taking place. And so if we look at the market through the lens of correlations, we will notice that last week we had a move in equities that was essentially the opposite of what we saw in other asset classes. What we saw in other asset classes, for example, in oil, in the dollar, and in yields, was the exact opposite. So we saw equities go higher, but yields go lower. We saw the bond market, of course, rally, and pretty much again everything else also go lower. So let me be more specific about this. We saw last week was the dollar sell off, we saw the oil market sell off, and we saw yields go down. The reason I bring this up is because what we saw throughout the year is a positive correlation of equities. So let's use the S&P 500 or even an equally weighted S&P 500 for that analysis. And we saw essentially a positive correlation all year between equities and the other asset classes I mentioned. So that's the dollar, that's oil, that's yields. So as those things went up, equities would also rise. What we saw this past week was the exact opposite. We saw all those asset classes sell off except for equities. And when you get to this part of the market, this part of the economic cycle, we need to get very clear as to why things are happening. So I've been in the camp of us seeing a slowing economy now for the better part of a year and a half, way too early, by the way. So 100% wrong there in terms of the timing of it all. However, I think the directionality is ultimately going to be correct, which of course is the difference between staying in business and out of business, is timing, right? So let's be very clear about that. But I think ultimately this will work out. And if we understand what happened last week, we can get a much better perspective of what might happen going forward. This is really important. That's why I always try to teach people, particularly people who are trying to manage their own money, as I said before, at least in part, like you're trying to manage your money, like 10, 20%, which I think is a noble sort of goal. What I try to explain to them is that the why matters, because the why allows us to understand and put better risk management processes in perspective. A lot of people will say it doesn't matter, a chart is a chart, and they'll just do what the chart does. I don't disagree with that either, but I have found that between our ears is usually where the problems happen, where we either don't admit ourselves to be right or wrong. And that's typically where we overshare welcome, both on the profit side or on the loss side or whatever. So and this is not always possible to understand the why. Sometimes the why doesn't make sense. In this case, though, like I'll show you in a minute or in a second, I think it's very clear. So last week, when did the market start to rally? For the most part, equity started to rally as we saw a weak ISM number come in. So ISM, which is basically a number that either measures contraction in economic activity or expansion. So above 50 is expansion, below 50 is contraction. Came in around 46 or 46.6, something like that, around there, which is pretty bad. And so what did the equity market do is it rallied. But why did the equity market rally? That alone wouldn't make sense. So this is where correlations and algorithms are important to understand. So that's why I like to point out the correlation between the dollar, gold, yields, and again, equities. So the first reaction that we saw last week was a continuation of what already started happening a little bit the week prior. The week prior is a bit of a bid in the bond market. So we had our annual Steady Trader Summit in Orlando, and we talked about that on that Friday. We said, listen, we're starting to see a bit of a bid come into in the bond market, yields backing up a little bit, and then that happened in a big way last week as the ISM number came out. So the ISM number the bond market correctly took into account that, hey, the ISM number, meaning a weakened economy, is telling us that yields at some point, bond yields will likely correct to some extent, go lower. The other markets got the same message. The dollar market got the same message. And of course, commodities such as oil got the same message. But the equity market loved it. Why did the equity market love it? The equity market loved it because there's a lot of people first of all, algorithms that are fine-tuned to this correlation of bonds going lower would be positive for equities. And that's a classic reaction, firstly. However, the more yields stay low, and I'm not saying yields ultimately can't go higher. I do think we're in a different yield regime. But I still believe that ultimately we'll see the 2-year yields come down to 3-ish% as the economy begins to slow, and it'll go back up again over time. But the more yields come down a little bit here, meaning the trajectory, that momentum to the upside in bond yields may have peaked, likely has peaked, the sooner people will realize, and specifically the equity market will realize that, hey, bond yields are not coming down because of any other fun reason. They're coming down because the economy is now slowing. And it's factually now happening. It's been slowing at the margin for a year and a half, but nowhere near where it probably should have given if we had a normal economic cycle, but we had an elongated economic cycle due to all the stimulus during COVID and so on and so forth that everyone knows. But now bond yields are coming down. And again, ultimately, we have a huge spending problem in the Western world, here in the United States, all the way out to Europe and other parts of the world. And that ultimately will probably keep yields somewhat higher. Anyway, so the equity market, long story short, had a big rally. If I just look at the equity market last week, I see the S&P 500 rallied, I think, about 6% or thereabouts last week, which alone is a big move. The question, of course, is what now? If history is any guidance, we should, from this point on, start to see things become a bit more difficult. So the S&P 500, for its part, has rallied basically right back to its 50-day moving average. I always like to say, hey, the 50-day, it's nice to know it's there, but it's not going to be it's typically not a very helpful measurement in terms of getting the timing too. I actually think the 100-day moving average may be a bit more apt to succeed. The 100-day moving average on the SPY ETF right now is currently at around 440. So that's not too far away from last Friday's highs. That's like literally 1.25% higher. For all we could stop here. But I'd be careful here chasing equities, but at the same time, want to respect a couple things. So first of all, let us just give a shout out to seasonality. I want to continue to mention this because I think it's an important point. I've been mentioning it to clients last week in advisory calls. That seasonality pattern is important. What I always like to mention at the same time, though, as well, is that the seasonality is a great statistic, but seasonality can be extremely misleading because seasonality will work a lot of the time, but when it doesn't work, it really doesn't work. So seasonality analysis without understanding where we are in the economic cycle is, in my humble opinion, pretty useless. In fact, I'm just going to call it flat out dangerous. So if you understand where we are, we got slowing ISM, we have student loan repayments are happening, very high interest rates relative to where they were a year and a half ago, not in absolute terms over long term, but in relative terms to where we were a year and a half ago, very high interest rates. All that stuff is now finally starting to come into the economy and slowing things down. Because of that, the odds of a year-end rally, and then there's some tax loss harvesting dynamics that are likely going to put further headwinds on the stock market. All those things make a year-end rally from here much less likely than usual. I'm going to say much less because I think it's typically about a 70-80% chance, or even more, like almost a 90% of the year-end rally. I think this year is probably 50%, say 50-50, which you might say, Serge, that's pretty useless. That's 50-50. Yes, but think about that percentage-wise. That means it's literally a coin flip. And I would argue maybe even a bit less than a coin flip as opposed to an almost guaranteed. So I think that's what we have to be careful of. So if we look at markets right now, and we look at the S&P 500 or we look at the German DAX, which I like to point out because it's cyclically trades a bit cleaner. I think a lot of these indices are really at initial overbought readings. If you look at Apple, for example, as well, they, of course, reported last Thursday after the close. Apple managed to close last Friday up about a half a point, so 50 basis points, filling its gap down. I think the stock gap down about 3%. It was a respectable move, but it wasn't like the stock took off. And so Apple's there's not a lot to read into Apple right now at this point. There's no growth in Apple, by the way, if you look at it. The stock has done pretty much nothing since May. If you peel back a little bit further, Apple stock has not done a single thing since actually 2021. So, for all the Apple bulls out there, just maybe be aware that the stock has basically gone sideways. This is not an anti-Apple comment. I own everything Apple, from watches to things to MacBooks here. I love the company. I don't think there's much growth right now, so we want to keep that in mind. Apple as a tell to push the market higher, that seems to be a bit of a stretch for me right now. So here are the dynamics. For me, for the end of the year, and I mentioned this in a webinar, actually in Orlando at our summit, I think there's a lot of reason right now to maybe put on some long positions in AGG for the rest of the year. AGG is the aggregate bond ETF. It covers the bond market. And I've mentioned this now for several weeks, so it's already moved quite a bit. The AGG ETF was up on Friday as much as 3.4% almost, closed the week up from the recent lows, up about 2.8%. So already a pretty big move there. But I like the idea of continuously putting more in yield. There's a lot of ETFs out there that capture the short end of the yield curve, like 3-month T-bills. Go find your favorite one there if that's something you're interested in. So parking as much cash as possible in that 3-month T-bill, to me, makes a lot of sense. Remember, 3-month T-bills is technically, as in the financial world, considered the risk-free rate, unless, of course, the government defaults, which is always possible, but not extremely likely, at least not right now. And so I think some sort of a combination of capturing a potential bear market rally in the AGG, parking a lot of cash, 60-70% in 3-month T-bills, to me makes a lot of sense. At the same time, I like the idea of having a little bit of upside exposure in equities, just in case we do get a year-end rally much further. Again, we just had a 6% move in the equity market in a matter of a number of days. That's a big move for equities. The NASDAQ 100, for its part, the QQQ, let's quickly measure it, had a rally of about 7%, getting it right back to where it was less than a month ago. So I don't want to disrespect that. As I'm saying, a small long exposure in the SPY, maybe 10, 20% in a portfolio of what I'm mentioning here. At the same time, I think there needs to be some protection. The puts have gotten more expensive over the past number of weeks, but the VIX completely crashed. Last week, the VIX was as high as 22, went out last week at around 14, 15. So buying some puts here for protection, again, to me makes a lot of sense. Again, a very, I think, confusing week last week for a lot of market participants that are not used to this kind of stuff. But as we have an economy starting to finally slow, this is typically, we tend to see a lot of volatility back and forth until ultimately we see the trapdoor open and equities have a swoosh until finally we can bottom more from a cyclical perspective. So that's what we're seeing here in the market. Is a lot of confusion, but again, I would argue here buying some VIX, i.e. basically S&P 500 puts at the money, put spreads expiring in a month or two or three, or at least probably more like 2 or 3 months, just from not to have too short-dated options. Makes a lot of sense with the VIX, again, back in the teenager territory here. I think, again, closing out last week around, let's call it 1490, makes a lot of sense within the context of the portfolio. That's a bit of a view from the trading desk here. Hope this helps folks have a great start to your week. As always, you can find more at studywealthpodcast.com. Make sure you help us spread the word. You can share these episodes. And again, if you would like to be a guest on our show or know someone you think you would like to have us interview or have as a guest, that would be more than welcome. You can just email us support@thestudytrader.com. Hope it helps, folks. And until next episode, be well and trading well.